The Bank of Canada announcement happened yesterday, and absolutely nothing happened. So from here on out, we've got to understand something. Nothing is going to happen. There will be no further rate hikes in Canada from our central bank. The Bank of Canada Governor Tiff Macklem is finished increasing rates for this business cycle. I shall decide, not you, you fat. Anyway, no, don't listen to him. He is finished. So there's no more rate hikes to think about. Put that aside. The only thought process, and please, everybody needs to stop trying to parse what he says. Stop trying to read tea leaves. Stop trying to issue hundreds of analysis of what he's thinking and doing and what's the future. Now, the future is there's no more rate hikes in Canada from the Bank of Canada. That's the future. There is only the waiting for the rate cuts. That's all. Our economy is stalled out in Canada, particularly in the key province of Ontario. Economy stalled out, and everybody who wants to argue with me about GDP, who wants to argue with me about job growth, who wants to argue, please don't bother sending any comments or any posts. It's stalled out. The economy is rolling over, and it's time to think about when the cuts happen. Now, the cuts may take a long time. It's possible. The cuts may be summer, fall, who knows? I've seen predictions for early cuts. Not my prediction. I don't even know. We got to wait, watch, and observe what goes on in January, February, and part of March, and then we'll know. Certainly, we'll know a lot more. Here's the thing. If the Bank of Canada cuts now, like quickly, cuts in January, it's an admission of bad management. That's all. Yeah, I ran this thing out so long, I screwed up. Now I've got to turn tail and run and start cutting right away. I screwed it all up. No Bank of Canada governor wants to do that, okay? They don't want to do that. So if the cuts don't start till the summer, the Bank of Canada could say, well, that was my plan. It's worked perfectly. Panic cuts, no Bank of Canada governor wants to do that. Never, don't want it, stay away, makes me look stupid, therefore I don't want to do it. All right. What's the good news? There's some good news. There was a great thing happened this week. One fixed rate mortgage rate fell below 5. We got a 4.99 high ratio purchase. So that's a CMHC. People are paying a premium. It's a small category. It's probably only about between 4 and 6% of mortgages in Canada. But that 5-year rate fell to 4.99, and that will continue to happen. So that's good news. That is absolutely good news. Now, what we have to worry about is, and why? Why did it happen? All right, bond yields. The bond market, the bond traders are deciding what the future is. And they've decided the future is rate cuts. And therefore, they front run that fact that the central banks, both here and in the United States, will eventually cut rates. And therefore, the bond yields go down. Okay, so when they go down, that means mortgage rates go down. All right, 4.99, good news, small category. Will it spread to more categories? Will it go even lower? The answer is, in all probability, yes, probably more slowly. The truth is, based on the bond yields, it could be a lower rate than it is today. It could easily have been 4.84, but there's seasonality to this. Banks don't like to be super aggressive on pricing in December and January. They know that the real important season for mortgages is in the spring. It starts in March, really, February, March, as people get pre-approvals for the spring market, the spring real estate market, when people do buy homes. Don't know how many that is going to happen this year. It might be a quiet year, but that's what we're talking about. We're talking about the busy time that banks anticipate when they want to fight for new customers, because that's very important to banks, new customers. And a new mortgage customer on a brand new home purchase or on a new home purchase or a first-time home purchase, that's a great customer. So banks like to have hot rates for that particular season. And in December and January, even November, they don't really care. If the rates are higher, that's fine. They don't care to fight. There's also some things to do with swap costs, hedge costs. They're higher today than they might be in the future. That's one of the reasons that all rates haven't fallen. They haven't fallen as much. But the truth is, the future is lower rates. And a quick caution, Right now, in the whole of the country, 5-year mortgage rates they will all start with a 5. And sooner or later, a lot of them will start with a 4, high 4s. But remember this. If you lock into a 5-year and the rate falls over the course of the next 18 months, if you want to cancel and jump out of that or break it, you're going to pay a fortune. It's going to be a big, big penalty to break that mortgage. So a really, really smart move, even though it's counterintuitive, is to consider taking a variable. Oh my God, Ron, you always said variable was terrible. Okay, times changed. New information, new recommendations. That's where we're at. Take a 1-year fixed. Even though it's expensive, take a 1-year fixed, take a variable. Because if you take a 5-year and a year from now, it's 1.25% less, you'll be kicking yourself. Keep that in mind. 1 year, 2 year, max, variable, because variable rate drops, and then eventually you can convert to a lower fixed rate, or variable may go all the way down. So keep that in mind for the future. Right now, unless there's a good reason to do it, grabbing a 5-year fixed rate may be some kind of trap.